Okay, good morning. I'm just gonna give it a few minutes while we wait for more of our attendees to join the meeting. Oops. All right, I'm gonna get started. Um, Good morning. I hope you're having a wonderful Friday. I'm Hazel. I'm an accountant at Brandmore. Welcome to our webinar on the risk of using business funds for personal use. So this topic is quite it's quite a troubling topic in our field because we tend to see a lot of clients who struggle with this subject matter. So I'm happy that we will be able to impart to you a couple of tips on how to best navigate this. But I'm just gonna get started with telling you a little bit more about who we are as Brandmore. We are a dynamic professional accounting firm that is based in Midrand, and we have branches in Zimbabwe and the UK, and we pride in calling ourselves your accountability partners as we live by this daily. Our director is Molin Mukuze. He's a CASARA and a tax practitioner as well. The services that we offer include secretarial services, consulting, audit and readiness, internal audit, payroll services, human resources services, tax services, as well as accounting services. So I'm just going to hand you over to Molin, who will be the speaker for today. And I hope you will find this topic to be helpful. Yeah, I'm over to you, Molin.
Thank you, Hazel. Thank you. Hope I'm audible. Okay. So as Hazel said, the topic of mixing business finance and personal or the topic of using business finance for personal use is something that we always encounter. And we've seen a lot of companies growing and having the same challenges as well, mixing personal, because you hear people saying no, but anyway, I am I'm the owner anyway of the business. The business is mine, which is something that people would think that you need to just use as you please the business finance. So the objectives of today is we want to understand the business as a legal entity, so that at least we can have that separation in that understanding. And we also would want to talk about impact of risks relating to mixing personal expenses with business funds and the tax implications of that. And we also need to look at the alternative solution for this problem. So how can people have alternative solution, enjoying the money that they would have worked for, but as well as separating the business expense from personal use, and how best can someone do that? So these are the objectives, and I hope that you're going to find this webinar useful and start to implement changes, key changes in your organization, so that you'll be able to be compliant. Okay, so just before we start, we're just going to ask a few questions. Getting to know you, what description best fits you? Are you a business owner, managing director, an accountant? Who are you? Let's just have that quickly before we move on to the business of the day. So if you, as this webinar is being recorded as well, if you're on our platforms, you can also put on our comment section. If you're on our YouTube, our Facebook, our LinkedIn, because we are we are streaming on those platforms. You can also put a comment there. Okay, so I see that we have about 13% managers or directors, and we also have 13% business owners and 75% 75% accountants, which is good, because I think accountants, they also need to know how best we can advise our clients to be able to have a solution for this. So just before we start, I just want us to talk about business and personal finance and try to identify or define what is business, what is a business, what is a company, and how is a company different from the owner or the director of it. So a simple definition: a company is a legal entity formed by a group of individuals to engage in and operate a business, commercial, industry, enterprise. So which means a company is a legal entity. I'm hearing a bit of feedback. So we need to be able to understand that a company is a legal entity, and a company may be organized in various ways for tax and financial liability purposes. So we have also done another video on our platforms where we spoke about the structures, different company structures, partnership, PTY, NPO, sole trader. So a company may be organized in various ways for tax and financial liability purposes, depending on the corporate law of each jurisdiction. So you need to be able to understand what are the forms, what are the ways that you can form a company within your jurisdiction. So that's a company. So, but what is key here that I want you to pick is a company is a legal entity. It's a legal entity, and it's formed by individual. So it doesn't necessarily mean that the company and the individual are the same thing. So that's a key thing to note there. So the key characteristics of a company is, these are the characteristics that are very, very important, such that when you are making a decision in a company, which position are you making the decision is? So the characteristic number one is ownership. So companies are typically owned by shareholders who would have maybe probably invest money or assets in return for shares. So ownership is often transferable, and maybe the company documents will talk about how the ownership will be transferred or how is it restricted via a memorandum or shareholders agreement. So the company is typically owned by the shareholders. And we spoke about legal entity. A company has a separate legal identity. So it's very, very important from its owners. So this seminar is very, very important because I see that a lot of people as well, when they start their businesses, they will think it's my business anyway, but we are forming a legal entity. You are owner, you are a shareholder, but the company that you have just formed is a separate legal entity, meaning to say it has a legal identity from its owners. Hence, I think if you listen to our seminar that we just did about IP, intellectual property, how do you protect it as a company as well? It comes in the fact that a company is a legal entity. It has its own identity from its owners, meaning it can be sued and it can sue, it owns assets and enter into contracts under its own name. So your company is XX, it's a legal entity and it has its legal identity. That's why it's very important to even protect the intellectual property of that legal company. And also limited liability, the liability of the shareholders or owners is limited to the amount that they have invested in the company. This means that personal assets of the owners might be protected from the companies, from anything that might want to, let's say you are sued and as a company and the owner, the shareholders or the directors, they might have certain protection. Although we need to understand that if you are a director, you're holding a position of you have a fiduciary duty to make sure you carry the conduct of the business in the best way possible. So limited liability as well. Management, the daily operation of the company are overseen by directors or managers. The directors have a fiduciary duty according to the Companies Act, while shareholders are usually involved in major decisions through votes. But if you are still a starting up business, you find that you play both roles, shareholder, if you're the owner of the company, shareholder and director role. So you find you need to make sure that when you are standing, which shoe are you wearing? A shareholder shoe or a director shoe? Go back to our YouTube channel as well and listen to that video that we spoke about the difference between a director and the shareholders and their role in the company. Although sometimes they wear the same people wear those two hats at the same time. Then also the company can do profit distribution, can distribute their profits to shareholders in the form of dividends, subject to obviously the company's profitability and the decision that the directors would have made within that company. So this is just a background to our conversation today because it helps us understand that when you have formed a company, it's a separate legal entity. Therefore, the contact and the decision that you are making in that particular entity, you are making it on behalf of the company. So the first thing that we want to talk about now is the impact now of mixing personal and business finances. So you'll find out these are, I can call them the pros, the disadvantages of mixing personal and business finances. So one is you have blurry financial picture, and this creates serious consequences for your business. You won't be able to track. You have tracking challenges. You won't be able to track as well. I'll go into detail on each and every one of those highlighted. You have inaccurate financial statements. These blurry financials can actually hinder you to make key decisions in the business, and it creates business cash flow constraints. And you also might have a lot of tax problems. We are solving a lot of tax challenges due to people mixing business finance using personal finance. Personal finance, using business finance for personal use. Sorry about that. So let's talk about the tracking challenges. Tracking challenges, when we are saying you can have tracking challenges or tracking problems, if your mixing transaction leads to inaccurate expense categorization, this can be forced, you are forced to categorize certain transactions inaccurately because you know that, let's say you're paying your fees for your child from your company account, you're now having a problem of saying, okay, how do I classify this in the business account? So you can have tracking challenges when you are when you have mixed transactions. Then also lost receipts. It makes it difficult to identify and track legitimate business deductions. So, you know, business deductions, you need them for your tax filing, and you need to have all your records in place when you're doing your tax filing. So lost, you can lose receipts, or you might not even know. Let's say you just have a business card, you're just swiping everywhere in the mall and everything like that. So you might be having difficulties. You can start to have difficulties to identify legitimate business transactions when it's time for filing your tax returns. Then also incomplete records, it makes it impossible to get a clear picture of your business financial health. So remember, when you're in business, you are in business to grow the entity. So if your finances or your business is, you are not tracking or not, you are mixing everything, personal and everything, how can you grow? How do you know the business financial health? It will be very difficult, and not difficult, but impossible to actually get a clear picture of your business financial health. And also another important issue is inaccurate financial statements. Misleading information. So your financial statements will be based on inaccurate records, and it's very misleading. And imagine when you have misleading financial statements, the type of decision that you will make in there. Overspending as well, it's a risk. You might unknowingly overspend on your personal items, draining the funds for the business. So it's a risk of overspending. Poor budgeting and forecasting. I think people who now know me know that I'm a fan of planning. Everything in the business should be planned for. So poor budgeting and forecasting, inaccurate records make budgeting impossible. We have found out that when we're trying to help clients to do budgets, so now we're saying, okay, how much expense are we anticipating for this line item? People, they don't know clearly because the base figure is inaccurate. So inaccurate record make budgeting impossible. And like what I say, decision making in company, in any business organization is very critical. So you have investment roadblocks. So this makes it difficult to assess potential investments or growth potential for your company. If you are mixing, you don't know when will you be able to attain a certain profit for you to be able to invest in a specific venture, which will make everything difficult. So investment roadblocks, you encounter investment roadblocks, and also unforeseen cash flow issues. So you can actually miss potential because you don't have cash flow for that. This becomes very, very critical because you won't be able to grab that opportunity as that come because you have unforeseen cash flow issues. You've drained the company funds for your personal use. And lack of financial control as well. Without a clear financial separation, it's very, very difficult to identify areas where you can cut on costs or even improve efficiency. Because remember, when your financials, everything is mixed, you can't, you won't be able to know where the largest portion of your funds, where are they going, and how are you going to spend, where are you going to spend most of your funds on? So you have lack of financial control there. Business valuation becomes a challenge. Should you want to dispose or sell your business or any shares now, you want to do valuation for your company, or should you want to have more investors coming in and you want to value how much should those investors pay you for the work that you've done or for the growth that you have built in your business? It becomes a very challenging exercise to do. So you'll be able also to identify business peak periods. It will be very difficult as profits will not be clear since the personal expenses are actually included in your financials. So these key decisions, if as a business owner, as a director, I know we have directors in here, and about 26% or 13%, I think 26% now that they are business owners. So as a business owner, you need to be able to make key decisions. But if you are mixing that, you are hindering the decision making of your business. And you're actually, in other words, you're killing your business opportunity. I believe that everyone who starts a business is to see it blooming and grow. So as you're stepping into decision making, but if you're mixing everything, there's investment roadblocks. You're going to face unforeseen cash flow issues. You have lack of financial control of your business, and it's going to be difficult to do business valuation, and you'll not be able to identify the business peak periods, and this will be difficult to identify where should you spend what and which period, because you are just mixing your business personal you are mixing your personal expense with the business funds. So the most important as well is the cash flow problems, right? So we all know that cash is king, and its unavailability will actually cause the following challenges. One, it's reduced available cash for business. So imagine you have found something in the mall, you just swiped the card for the business, and something come, and that in the business on Monday you coming, there's not something that needs to be done, or a decision that needs to be made, or a tender that needs to be submitted, and it needs resources for that, and you won't have. So it reduces the available cash for business if you are mixing everything. Limited investment opportunities as well. I think I mentioned that when you're making decision, investment roadblocks. So if you don't have cash, you are limited in making decisions. As an entrepreneur, you need to know that you need to be always open for opportunities and where to invest that. So if you don't have cash, you are nothing as the business is growing. So you need to evaluate, why do I not have some cash in my business? Because not having cash is actually limiting your investment opportunities. You're gonna get some deals that need cash now, and you won't be able to get into that because you don't have a cash. So you would have limited the opportunity of you investing in that business opportunity. So increased borrowings as well, as you see that the economy right now, interest rates are very high. So if you don't take care or manage the cash flow problem of your company, or manage the cash flow of your company, you are going to find yourself increasing borrowing. And what does that mean? You have you won't have sufficient funds to carry on or pay the expenses. And what does that mean? It's more costs to your business. So you need to borrow more. And when you need to borrow more, it means you need to repay more. And the banks need their payment as and when you have, or if you agreed to borrow 20,000 today, or whatever, 100,000, you need to repay that. It's an obligation that you have created. So we have found that if you don't manage the cash of the business, you end up in debts. I'm not saying debts are bad, because the debts, there's good debts in terms of business and bad debts. I think also we need to have a session around that to say, what are the important, how do you fund the business, and talk about the different issues as well on one of the seminars that we are going to do. So, but sometimes we end up having a credit card for that, and that is very expensive borrowing, and actually straining the company further. So cash, remember, cash is king. You also are under the reduced availability of cash. You have people that you need to pay. Your supplier, you delay paying. And the more you delay, no one wants to do business with you. And you would have damaged your credit worthiness and your reputation as a company. Imagine all the suppliers that you are dealing with, they don't want to deal with the business because they know that you don't pay. So imagine your reputation, your credit worthiness, and also your staff delays. Imagine telling your people that you can't give them their salaries, and it's something that will kill the morale of the employees. So these are the challenges that you have when you don't manage your cash flow. Then overhead cost as well. You have your fixed or necessary expenses that you need. You might not be able to pay them on time, or there will be a lot of disruptions in your business operations if cash is strained. So also, I think I've emphasized this limited opportunities. A health cash flow allows you to reinvest in your business. So when we are talking about investment, we're not necessarily talking only about investing outside. So in the business, when let's say you started the business today, you need to see areas of reinvesting in your business, maybe in the systems, efficient ways. You need more money to create a lot of systems, or you need more money to hire qualified people, so that it's a reinvestment for the growth of the company, or even more marketing initiatives to grow your business. So, or even like equipment upgrades. If you are in manufacturing and all those, you see that equipments sometimes the equipment that you use will retire because they want to be upgraded, or they won't be suitable for that. So investing within the business can actually be a challenge if you don't maintain a health cash flow, or if you actually mix your business with your personal expenses into the business, eating out the potential for growing that business. So and not you not also be able to grab opportunities they come, which is very important. I think I've mentioned that as well. So the other consequences of mixing this is a breach of trust, and using business funds for personal gain can severely damage trust with various stakeholders. I think we spoke about creditors, which is your suppliers, your investors. If you are misusing business funds, it can actually jeopardize your future investment opportunities as well. I think we mentioned that your creditors, your employees might actually not trust the business, and you find people leaving your organization because they're not certain if they're going to get their salaries in the next month. So you won't get investors, because most investors, when they want to invest in a business, they look at your financials. And remember, we spoke about mixing, how that it will impact your financial statements. And if the profit is very low, it's actually an indicator of something that is this company viable, and they might not be able you might not actually be able to get investors in your business. What about, someone might say now, what about the tax implication of mixing? This is an issue. I think we are sitting with a lot of cases that we are dealing with right now, where SARS will just say, we see you have declared this, but we've seen this and this happening in your account, so that we want now to look at the tax implication of mixing your business funds, your personal expenses, swiping and everything in the business account. This is very important. So remember, there's something that we call deductible expenses. SARS allows businesses to deduct legitimate business expenses from their taxable income, thereby actually reducing your overall tax liabilities. So when finances are mixed, it becomes difficult to differentiate between personal and business expenses, which will make it hard to identify whether that expense is deductible or not. So with that difficulty, you can actually end up not deducting what you were supposed to deduct as a business and losing out on tax. So without also proper records and receipts, SARS might disallow certain deductions. Remember, when you're mixing, you won't even keep receipts sometimes. So it will be difficult now to prove or get the records for that deduction, leading to higher taxable income and potential hefty taxes, or even penalties if they found out that you didn't submit proper record keeping. So penalties from my end as an accountant, as an advisor, as an accountability partner, from Brainmore's perspective, we always call penalties and penalties and interest a fruitless and wasteful expenditure, as they can be avoided. It's something that you can consciously do as a business person who is eager to grow the company. Consciously do and put in place so that you can avoid penalties. If you having penalties, paying penalties to SARS, it means that there is a critical decision making that you need to make as you are growing your company. You cannot afford to pay penalties and interest. So that means you need to put in key decisions around in your company if you are really serious about growth of the company. So from an accounting perspective, if the director uses business funds, obviously they can be recorded as a loan to the director from the business. So you're not gonna tie yourself on the neck to say, I've used this, so then what? We're going to record that as a director's loan, or loan to directors, something like that. If the loan is also interest-free or lower than the official rate, SARS would deem that the difference as a dividend. So you need to understand that. Let's say you have taken money from the business, you have mixed. So on the accounting, we say it's a loan. If the business was giving you the loan, right? If it was not salary. So then we need to understand, because a loan, it has to have terms. No one get a loan for free. Remember, we talk about the separation between yourself and the company that you're running. So then SARS will say if it's lower than the interest, acceptable interest rate, the difference, it's called a deemed dividend. So the difference between the market related interest and the zero interest that you would have given yourself, you will need to declare that dividends there. So it's still on tax implication, the audits and penalties due to deduction of personal expense under the business account. So SARS can randomly, especially these days. And I always tell the clients, and that's why we always run these webinars to educate the clients, the people that we serve, because we call ourselves accountability partner and we are living daily by it. So these days, SARS is using AI. So they randomly select business for audits or people for audits. So mixed finance make it difficult to provide a clear, accurate financial record during the audit. So now you're audited, you bring your records, and we're trying to find, okay, which one is business and which is what. It's going to be difficult to respond on that audit. So this can actually raise red flags for SARS and potentially lead into tax reassessment. So now let's say SARS say you are audited, submit the documents in 10 days. And because we are mixing, it's difficult to put everything together in 10 days. SARS will actually say, no, there's a red flag here. And tax reassessment, SARS might reassess your tax liability based on their findings, resulting in actually in additional tax owed. Also, penalty and interest as well. Failing to maintain proper record or underpaying tax can lead to significant penalties and interest charges from SARS. And you know, when SARS put a penalty on your account, it's a hefty. And it's a lot. I think you can go on our YouTube. We ran some shorts telling you more about the penalties. How much are they? Up to 9,000 can be a penalty that you have to pay for non-submission or when you're audited and found out that you are mixing business expense and you actually deducted expenses that doesn't need to be deducted. So before we just go further, we're just going to run also some questions there. Are you in your business, are you separating the funds, your personal funds, or then your business funds? Do you need help with the above? Maybe we can just do a consultation with you, helping you to make sure that you clearly set and ask questions, because we are not necessarily saying you don't need to have money as a business owner or as a director, as a shareholder. But what are the channels? How do you do it so that at least your business is? So we're just going to run that so that at least we can hear your feedback there. Are you winning? Okay. Okay. So you can just answer that question, those two questions. Okay. So other people are still answering, but so far 25% need help with this. So please write a message to on the chat to a person. Pray more. We can arrange a meeting so that at least we can really help you to set that and advise you on the best way forward. We can have a 30 minutes free consultation with you so that at least we can help you set up everything there and advise you on the best way forward for your scenario and your case. Then others are saying, 80% is saying, yes, we are separating business and personal. 20% no, they're not separating. So we need to educate and help the businesses as they grow so that they put things in order. So thank you for that. So get in contact with us so that we can help you. 30 minutes free consultation. We'll be able to get into a call with you so that we can pretty much set up everything for you and give you advice, a proper advice on how you can do that. Okay. So let's move on. Someone might say now, okay, what are the alternatives? Because I think half of this seminar we've been talking about the impact, the consequences. Why you should not mix? So what are the alternatives to mixing finances? So setting a salary is one of the owner's salary or drawings is one of the important things. So setting a salary, determine a fee. You see, I always tell people, some clients will say, no, I've set a salary, but they set the salary too low to the extent that they cannot even live within that small salary. It's dangerous. So determine a fair and reasonable salary for yourself. And regularly pay yourself regularly, salary consistently, pay yourself a salary from your business. So get on the payroll of your company, get onto the payroll and pay your salary, self a salary consistently. That's one important thing. So this will actually instill financial discipline, and it also have a tax advantage because a salary from company's perspective is an expense that you can actually deduct, and the company can actually pay the tax on behalf of you on that salary, leading your individual tax issues to be also clear. So if you don't have an RP5, yet there's money flocking in and out of your account, it's a risk when SARS run those AI, right? You don't have an RP5 and you are not doing your returns or something like that, and it's a risk on your personal individual tax as a director or as an entrepreneur. So paying yourself salary instills financial discipline. It has tax advantage from the company's perspective, and also accurate records keeping for your company and for yourself. And secondly, if you need large lump sum of money, obviously, provided if your books are done correctly. I know when people start a company, they don't start from, the company doesn't have money. So at some point as a director, you've invested a lot of time, a lot of money into the business. So you should have created a director's loan. So obviously when you're now paying yourself, the company is repaying that loan. But if there's no that loan, you can use director's loan account to get some funds from the company. But take note that if it's an interest-free loan, the difference between the interest rates and the rate that you're giving yourself can be deemed dividends. So the director can withdraw money in the form of a loan and charge interest on the loan balance, right? And that interest will be deductible expense for the company. So one thing, if you don't understand anything out of this webinar, understand that you and the company are two separate legal entities. So you need to be able to treat the company that way. So the benefits of those is controlled cost as well, and the tax deductibility of the interest, because the interest is actually an expense. The interest is actually an expense, right? So it's actually deductible as well for company perspective, from company perspective. So from the company perspective, it's like an income. Because it has loaned you money, but from your side, it's actually an expense on that loan because you wouldn't have gotten the loan, right? Controlled. Okay, so let's talk about another option as well, dividend versus salary, and which one the option that you can utilize. So dividends is a distribution of a company's profit to its shareholders. Think of it as a performance-based reward at the end of the year after you've done your financials. You look at the profit that you've made and you do the declaration of dividend, and the company is obliged to actually withhold a certain percentage of tax to pay over to SARS. But as the company is growing, before you do dividends distribution, please consult so that at least we can tell you, is it cheaper for you to pay that money as a salary rather than a dividend? I think we also did a video called dividend versus salary, where we were looking at scenarios to say at what point would dividend make sense? Because remember, you would have your income less your expense, that's your profit, and you would have paid tax depending on the rate where you are. If you're a small business corporation, using those tax tables. But if you are now a big company, at 28%, you would have paid, at 27%, you would have paid tax, right? And now when you declare, you need to withhold dividend, which is like 20%. So effectively, that money will be taxed twice. So that's why when you want to declare dividend, consult so that we can tell you to say, you know what, looking at your salary range is actually best for you to take this money via a salary than a dividend. The company only pays dividends if it makes a profit, and the higher the profit, the larger the potential dividend payout is to the shareholders. So dividends are to the shareholders. So the pros of dividends, tax advantage. In some cases, dividend may be taxed at a lower rate than the salaries, depending on the scale, salary scale that the taxable scale or range that you are at. Reflects company performance as well. When your company is declaring dividends, and when you tell the potential customer investors, they will see that this company is performing. You share in the company's success when it's only profitable. If it's not profitable, you will not be able to declare that. So it's an indication of a company being successful when you start declaring dividends. Then the cons, unpredictable income. If you only want to pay yourself via dividends, it's an unpredictable income. Remember, there's a condition that the company need to be profitable, because as a director, there are some tests that you need to do, liquidity tests, before you actually declare a dividend. So limited planning, the variable nature of dividends makes it difficult to plan your finance if you're only relying on dividends. You will not be able to plan your personal finance as an individual. Salary, the advantage is salary is your regular compensation. As an employee, you receive that regardless of the company's profit. This actually implies even if you are the owner or operator of the business, you can get a salary as well. Think of it as a fixed income and for your contribution to the company. So salaries, that's why sometimes it's good for you to get salaries, but if in your company, it's good to pay your employees salaries, but supplement that by performance management, because it's very, very important. Because if someone say that, see that they just get a fixed salary, unless if you have very good people, someone will just come and sit, know that they are going to get their fixed salary anyway. So you need to supplement that with performance management processes, so that at least the salary that you are paying for the team is contributing to the growth of your company. But salaries, it's a regular compensation that you receive regardless of the profitability of the company. So the pros, fixed and predictable. It provides a consistent income stream, simplifying budgeting and personal finance management, because you also need to budget and to see what are the investments that you need to do on your personal capacity as well. And salary, tax withhold, pay as you earn is withheld by the company. It's so streamlining your tax. At the end of the year, when you do your tax, you already have your IRP5 because the company has been paying the salary for you. Then potential higher tax rate. So it's very important to also do salary structuring, so that at least you see at this rate, stop at this rate, and any other thing that you need to get it via dividends, because we do want to manage tax efficiency. So not directly tied to profits, which is an issue. That's why I'm saying in a company, you need to back that up with performance management as well. So because it's not tied to the performance of the company, you receive your salary regardless of whether the company is making a profit or loss. So choosing between dividend and salary is not a thumbs up thing. The best option for you is, it depends on the following. Obviously, your risk tolerance. Are you comfortable with only receiving income once, or do you prefer a steady paycheck, which I think everyone have costs, which is a preferable? And also financial goals. Do you need a constant income for immediate needs, or are you looking to for long-term returns, dividends? We call them long-term returns because it's uncertain whether the company is going to make a profit or not. Tax implication. This is very important. You need to consult on this so that at least you know what is the best option for your case, because there are tax implications for both options, depending on your specific tax bracket and your financial situation. So I think this is the conclusion of the webinar. We have spoken about the impact of mixing personal and business funds. We've also spoken about the tax implications, which is very critical, which you actually need to look at the tax implication looking at where the world is going, world of technology. So you can't hide anything the way we are going in terms of, because we are in the industry, we're seeing what's happening. So it's difficult to hide anything. So you need proper advice. Takes efficient ways of avoiding. Remember, avoiding tax is not illegal, but evading it is illegal. So you need those advice as well. And also we have spoken about ways of paying yourself. We spoke about, I suggest to start on a salary, consistently pay yourself a salary. That is comfortable. If you need more than the salary, find ways and means. Is either if you had a loan already in the company, repay the loan, or borrow the funds, but it should make sense. That's why you need accountability partners to say, you can't say the company has been giving me more loan than one they can pay, you find out someone saying it's loan, but that account will be so huge to the extent that you can, even when SARS do their analytics, you cannot even, they will say, no, you are just evading tax here. You are now evading via the loan account. So you don't necessarily need to abuse that. So ways of paying yourself, there are different ways that we spoke about: loan, salary, dividends, and we also spoke about the dividends versus the salary. And we go for these examples, with examples and everything. Go to our YouTube channel as well, and you'll be able to find a video that we did about dividends versus salary. We were actually giving examples on there to say, let's say you need 100,000 or whatever the case may be. So it's explained well in detail on our channel. So I'm just going to hand over to Hazel for any questions if they're on the charts, or anyone with a question in the platform.
Right. Thanks, Marlon. We don't have any questions in our chat, but I'm just gonna allow people to ask their questions if there are any, and hopefully we can help.
Okay. I believe the absence of questions means everything was clear. Unless if there's any. Is there any question? Because I can't see the people. Okay. No, thank you. Thank you for that. In the absence of questions, let's talk about our next webinar. We are going to talk more about the importance of audits for estate agents and also attorneys, because we are auditors as well. This is the peak period of what you need to know and how you can. So that's our next webinar on the 24th of May. Tune in as well, the importance of audits for this particular webinar. Other than that, you can connect with us on our YouTube channel, Brainmore Business Hub channel. Go visit a lot of content that we are putting there that is helping a lot of business. We are getting a lot of feedback from businesses to say, you know what, we are getting knowledge out of this platform. That's why we keep on actually posting, because we are seeing how it's helping. You can also email us at help@brainmore should you need assistance, or call us on those numbers that are indicated there, and even visit our office and even our website as well. I think we post a lot of blogs of what's happening in the industry and what you can learn from a lot of things, changes that are happening as well to grow your business. Thank you very much. I hope you got helpful tips from this presentation that you are going to implement in your company and for the business growth. Thank you. Over to you, Hazel. I think we are done.